Trying to figure out the best way to protect your hard-earned savings from the ever-increasing inflation concerns can be stressful. Unfortunately, the way that most people are invested, the mainstream stock and bond buy and hold approach, is not going to cut it. In fact, those are some of the worst places to be invested if inflation is your concern. Beyond answering this question for you, I'm going to show you the best ways to profit from this inflation. Let's start with the 3 places not to invest if inflation is your concern. Number 1, bonds. Mainstream advice tells you to always have a healthy, diversified allocation to bonds. Maybe 20% if you're younger, 40 to 60% if you're older. Here's the problem. We don't have a ton of examples, historically, in the United States of prolonged or runaway inflation. So that data that inform the mainstream stock and bond recommendation does not really help you if during the first decade of your retirement, for example, you experienced 1970 levels of inflation or worse. Bonds are one of the worst things to own during periods of high inflation. That's a big reason I wrote my book. That blanket advice that everybody just wants to plug you into is actually potentially ruinous during some economic environments. Warren Buffett warned that bonds are not the place to be these days, and that fixed income investors worldwide face a bleak future. And Ray Dalio said that the economics of investing in bonds has become stupid. They said this because bond performance and interest rates have such a strong inverse correlation. That is to say that as interest rates rise, bonds fall. And with interest rates at 0, well, the future of bonds does not look great. Add to that the fact that increasing interest rates is the best way for a country to fight inflation, and the future looks even more bleak. In fact, the real rate of return for bonds during the last time we had rising interest rates to fight inflation was an annualized 0.2%. That's 0.2% per year for almost 3 decades, from 1953 through 1981. Now, there are a lot of reasons that the government will try to avoid increasing interest rates for as long as they can. It would make their enormous debt load way more, perhaps too expensive, for example. It very well may push us into a recession or even depression. Honestly, they've kind of backed themselves into a corner here, but that's a whole nother issue which we can address in more detail next time. So what about tips? The government's Treasury inflation protected securities. After all, the government created TIPS as the investment solution for those who are concerned about the potentially severe negative impact of rapidly rising inflation on their wealth's purchasing power in retirement. Once you understand the discrepancy between the way the government accounts for rising inflation and reality, you realize the potentially significant shortcomings of this proposed solution. They're not going to keep up with actual inflation. I walk you through all those discrepancies so that you can understand them yourself in this video. I'll link out to it at the end of this one so that you can easily get there next. So bonds and TIPS are out, at least as far as real inflation protection is concerned. The third place you should avoid is cash. Now, that may be obvious to some, but cash is kind of the ultimate, I'm scared and don't know what to do, default for investors. But if inflation is your concern, that's going to pretty much be your worst option here, since inflation is effectively just your cash losing its value, its purchasing power. So where should you invest to best protect yourself and potentially profit from inflation? I asked you all, and you had some great, thoughtful answers. Thank you. Now I'm going to walk you through 5 investment options and 3 bonus considerations you should make as you piece together your custom inflation-hedged investment portfolio strategy. Disclaimer, I am a registered financial advisor with a fiduciary responsibility to provide my clients with what I believe to be the absolute best options to help them achieve their financial goals. This almost always involves some degree of customization. In other words, the following ideas are obviously not meant as specific recommendations for you and your unique situation. By continuing to watch, you are agreeing to these terms and conditions. Now, when I asked you where you should invest, the stock market was actually the most common answer. But in general, if you just have exposure to the market as a whole, either to the S&P 500 through an index like SPY or VOO, or the total market through VTI, for example, historically, periods of high inflation correlate with lower real returns. That is, the return after adjusting for how much more expensive everything is. So if you expect inflation over the next few years or couple of decades, and you're just investing in a broad-based ETF, you might want to lower your expected real returns a bit. That being said, if you do insist on managing your own money and investing in broad-based ETFs, you could narrow your focus just a bit to better prepare yourself for high inflation. And once again, I asked you the best way to narrow your focus here: value, growth, or income. And your responses were mixed, so I'm glad we're covering this. Of those three, the best inflation hedge is actually value stocks. Now, this is the worst of the 5 investments we're going to cover here, but probably the easiest for you to take action on. If you were to break the total market up into growth and value, historically, value stocks as a broad class, as a group, have tended to outperform the market as a whole during these times. Growth stocks, on the other hand, have historically had a negative correlation to rising inflation. That is, as inflation rates go up, the performance of growth stocks relative to the rest of the market goes down. Dividend stocks also tend to underperform during these times as the dividends don't keep pace with inflation, which, by the way, can create good buying opportunities for long-term dividend investors. So if we do experience a prolonged period of high inflation, keep an eye out. But what would be even better than any sort of broad exposure would be individual stocks. It's impossible to fully understand everything in which you're invested when you're invested across an entire index. If/when there's a massive correction or crash, it's important you understand your underlying investments. If you don't, how can you expect to remain calm during times of chaos?
Buy! Man, this is great. The market will continue to grow forever. But what if it doesn't? Oh crap, I never thought of that. Sell!
Stocks you've researched and understand will serve you much better here. In fact, I believe that to always be the case. So I'll definitely continue to provide you with resources, videos, to help you know how to compare companies, study financial statements, identify the best entry and exit points, and so on, so that you'll be better equipped to do just this. In general, when you invest in something with which you are intimately familiar, and you've prepared yourself for a full range of various future scenarios, your investments will fare much better over your lifetime. In this case, in this inflationary scenario, you're looking for businesses that won't need regular infusions of cash to stay in business. Think about those growth stocks we were just talking about. For businesses that are not profitable or self-sustaining today already, as they have to take out more debt at higher and higher rates, their financial prospects will look worse and worse. This is why Warren Buffett says that the best businesses during inflation are the businesses that you buy once and then you don't have to keep making capital investments subsequently. Any business with heavy capital investment tends to be a poor business to be in an inflationary environment. He further offers that a brand is a wonderful thing to own during inflation. Recognized name brands can more easily increase their price to the consumers without risk of losing as much market share. So start researching value stocks to add to your portfolio. Look for brands that might be more insulated from price hikes. People are still going to buy milk and eggs even when their prices go up. What brands also carry that level of perceived necessity with their consumers? Also, another quick tip. During times of economic pressure, like inflation increasing the cost of all companies' expenses, the larger established players are often positioned to withstand the pressure much better than their smaller competitors. Number 3, real estate. This is probably one of the best inflation hedges if you can pull it off right, as in getting good properties at fair prices. At the very least, you could get broad exposure to real estate investment trusts or REITs. They have historically, when you factor in both the price appreciation and the income they're required to pay you, tended to outperform the S&P 500 during periods of even moderate inflation. But rather than broad exposure, I would include any REITs you're considering in your stock analysis, what we just talked about in point 2. As always, owning something you intimately understand, their debt levels, where their properties are located, what types of real estate they invest in, and so on, will serve you much better. What would be far better would be for you to own physical rental properties. I would only recommend this, however, if you are legitimately interested in keeping up with either your properties and or a property manager, and you're familiar and comfortable with the very real risks involved. Again, a subject for another time. But if you are interested and you are comfortable with the risks, then this might be your best way to profit from inflation. Specifically, when you're able to take out a reasonable mortgage at today's rates. Remember how bonds perform poorly during inflation? Well, bonds are just someone else's debt obligations that you own. So the other side of that is that the negative aspects of debt, like mortgages, get significantly reduced as inflation increases. In short, an inflationary environment is the best time, if there is ever to be a best time, to have debt. In addition, the value of your properties and rental rates you're reasonably able to charge should be going up in sync with inflation. You do have to be careful here, as many of the larger metropolitan statistical areas have already experienced insane price appreciation over the last couple of years, to the point that I would be concerned as to when those regional real estate bubbles might pop, even despite a broader inflation economy. For me, I tend to look for rental properties in smaller cities and towns, one with a more moderate historical price appreciation. I explain that further in this video here, which I'll link out to in the description so that you can open it in another tab and check it out after this. But hold up, here's a very real concern with all these, stocks and real estate. I've alluded to it already within each one, but wouldn't it be possible for there to be a crash in either or both the broad stock market and real estate market, even during a period of high inflation, or perhaps even perpetuated and accentuated by that very fact, by the rising interest rates perhaps? Well, yes. The answer is yes. So let's continue to build out our inflation protection portfolio then, but with that in mind as well. Mark Cuban's investment proposal for the everyday investor will be especially valuable here with physical goods.
Use the transactional value of cash. I know I'm going to be buying a bunch of toothpaste for my family. I know toilet paper. I know all the consumables that I have. I can take my cash and go get a better value. You can get a better return and you'll end up with more cash than trying to fight the John Paulsons of the world and these guys who have hundreds of analysts who are working for them.
It's super boring, sure, but it's honest. If you're concerned about inflation over the coming years, stocking up on the products you already consume could provide you with a surprisingly significant return on investment. But it's also easy. Will help reduce some of the anxiety that will inevitably come during a stressful inflationary time, and doesn't require any investment knowledge or extra research/work on your part, like pretty much everything else here on this list would. Number 5, commodities. Inflation is defined as a general increase in the price of goods and services. Having exposure to commodities is very literally just owning goods at their most fundamental level. I'm a big fan of owning actual things. As the cost of all the inputs needed by businesses go up, if you actually own those inputs, or in reality, in this case, futures contracts on those inputs, you stand to directly benefit from those price increases. Recent research from Vanguard found that a 1% rise in unexpected inflation historically has produced a 7% to 9% rise in the price of commodities. A much better directly correlated inflation hedge than just the broad stock market. Now, we can talk about gold in this category as well. Ultimately, it is a commodity. Historically, gold has been considered the ultimate inflation hedge, and I tend to believe that over a long enough period of time. But historically, over the short and medium term, it doesn't always keep pace. It doesn't always have an immediate inverse correlation to inflation. Now, that being said, the last time we experienced crazy inflation, like it seems as though we could be gearing up for today, the price of gold saw an annualized increase of greater than 30% for almost a decade. So commodities, including gold, can serve as an inflation hedge. You can use the things that we've talked about thus far to build out a well-diversified portfolio, to better insulate yourself and potentially profit from inflation concerns. But also, if done right, if done thoughtfully, you can also design your portfolio to help protect yourself from any potential future market chaos as well. A severe correction, crash, recession, depression, or whatever we might end up calling it. These next 3 bonus considerations are essential for any sound portfolio design to make sure you're prepared no matter what happens. Hyperinflation, a worse than ever before crash, or even if things just continue, all rainbows and butterflies. Bonus consideration number 1, intelligently enhanced diversification. We've talked about diversifying across those 5 inflation investment options, but you have to make sure to not just diversify for diversity's sake. You have to be smart about it. Too much diversification and diversification into investments you do not fully understand can result in even greater losses. As you're building out your diversified portfolio, you need to seek a lack of correlation. I worry about a 2008 type crash happening in the future, as in a crash where everything comes down together, like it did during the Great Recession. This is the scary part of any portfolio design. For me, this isn't me just fear-mongering. This is me sharing my own personal concerns that have led me to where I am today. And that's even constantly evolving the more I study and research, trying to find the best answers for my clients and selfishly myself. I know what you must be thinking, and yes, it is a bit depressing and very stressful being inside of my head trying to figure this all out. Intelligently enhanced diversification is an art. It's what I try to do for myself and my clients. I don't have it perfected by any means, but it can make a big difference in how well you're prepared should the market crash like it did in 2008 or even March 2020. Or should we experience runaway inflation like we did in the 1970s? Or all of the above. With the reality that many of these traditional asset classes could crash down all at the same time, and given the unpredictability of what the future could hold as far as their recoveries, think Japan's 30-plus year timeline or 1929's 89% drop, those were unprecedented when they happened. You never know exactly how the next crash will play out. With those considerations in mind, these last 2 points come into play. And I'm only going to touch on them briefly, as they are a slight distraction from the actual topic of inflation, but if I'm being honest, they absolutely would be considerations for any inflation-protected portfolio I design, and they should be for you as well. If you're interested in diving into either more, or any of these subjects more, let me know in the comments below. Bonus consideration number 2, downside protection. I figure out downside protection strategies for almost all of my market-based investments. You could use stop losses to accomplish this. They would, for the most part, protect you from major drops. You would still have some risks though, gap risk, for example, where overnight the price could drop by a significant amount. There's nothing you can really do about that with stops. See what I'm talking about? It's depressing. Now, I'm not a fan of arbitrarily placed stops. You need to know why you're choosing to get out. What alarm bells are going off? What fundamentals have now changed by this price movement? Or at least, what does this move suggest about the future of this position? To fix that, to know how to come up with logical places to put your stop loss orders, you could learn fundamental analysis. At what point has your thesis been invalidated? Or technical analysis. When is the current trend or momentum more powerful than the original narrative that led you to invest in the first place? Or tactical strategies. What historically/probability-based rules should you follow? And come up with a logic-backed way to set those stops. Most people don't have the time for that.
Ain't nobody got time for that. Ain't nobody got time for that. Ain't nobody got time. Ain't nobody got time. Ain't nobody got time for that.
That's not going to stop me from making videos explaining each if you'd like to learn. But if that is you, you know you don't have the time to learn and keep up with all that. And if you have enough to protect, that's a good reason for you to find and have a competent financial advisor to help you. Instead of stops, you could use put options, like if you don't want the long-term capital gains, for example. But that makes it even more complicated. They can be expensive too, so you might want to consider using option spreads to offset some of the added cost if this is the route you end up pursuing. But once again, that's making it even more complicated and much more difficult to keep up with. And don't forget to let me know in the comments if you're interested in deeper dives into any one or all of these specific strategies that I'm just touching on here. The final consideration I would make falls under the umbrella of building out an even more intelligently enhanced diversification for yourself. Bonus consideration number 3, alternative investments. I'm not necessarily talking about hedge funds here. I'm talking about strategies that are so obviously uncorrelated to the other investments you own, like owning mineral rights, investing in art, or even just your own business. Some of these options, the easiest ones that could be used to accomplish the enhanced diversification goal, are unfortunately only available to so-called accredited investors. But once you get to that level, they're worth checking out. And again, this can be a big value add that your advisor brings, the researching, understanding, vetting, and monitoring of your options here. But intelligently adding entirely uncorrelated assets to your overarching strategy, to your overarching portfolio, can definitely help you better prepare for any sort of future crash, but also better protect you and insulate you from the effects of inflation. Now, if you don't understand how important it is that you build out your portfolio in a way that will better protect you from inflation, then this video is for you. Because I hate to break it to you, but inflation is worse than everyone is telling you. Good luck out there. Take care.